Gold volatility is a measure of how much the price of gold fluctuates over time. It reflects the uncertainty and risk in the gold market, as well as the global economic and geopolitical conditions that affect the demand and supply of gold. There are different ways to measure gold volatility using indicators, such as the CBOE Gold ETF Volatility Index, GVZ, or the historical volatility of gold prices. These indicators can help traders and investors to understand the risk and opportunity in the gold market and to adjust their strategies accordingly. The CBOE Gold ETF Volatility Index, GVZ, is a popular indicator that tracks the implied volatility of gold exchange-traded funds, ETFs, such as the SPDR Gold Trust, GLD. The GVZ is calculated by using the prices of near-term GLD options, which reflect the market's expectation of future gold price movements. The GVZ is expressed in percentage points and can be interpreted as the annualized standard deviation of GLD returns. The historical volatility of gold prices is another indicator that measures the actual volatility of gold prices over a given period of time, such as 30 days, 90 days, or 1 year. The historical volatility is calculated by using the standard deviation of daily gold price changes, which reflect the past fluctuations of gold prices. The historical volatility is also expressed in percentage points and can be compared with the GVZ to see if the market is overestimating or underestimating the future gold price volatility. Both indicators can be used to identify periods of high or low volatility in the gold market, which can signal different trading opportunities. For example, when the GVZ is high, it means that the market expects large price movements in gold ETFs, which can create opportunities for buying or selling options. When the GVZ is low, it means that the market expects small price movements in gold ETFs, which can create opportunities for buying or selling ETFs directly. Similarly, when the historical volatility is high, it means that gold prices have been fluctuating a lot in the past, which can indicate a volatile or uncertain market environment. When the historical volatility is low, it means that gold prices have been stable or trending in the past, which can indicate a calm or predictable market environment. By using these indicators, traders and investors can measure and monitor the gold volatility and adjust their strategies accordingly. For example, they can use different time frames to capture short-term or long-term volatility trends, or they can use different technical tools to identify support and resistance levels, trend lines, or breakouts. They can also use other factors, such as fundamentals, sentiment, or news events, to complement their analysis of gold volatility and its implications for the gold market. Technical analysis is a method of analyzing the price movements of gold and other assets based on historical patterns, trends, and indicators. Technical analysis can help traders identify trading opportunities and entry and exit points in a volatile gold market. One of the most basic technical analysis tools is the trend line. A trend line is a straight line that connects two or more significant highs or lows on a price chart. A trend line can show the direction and strength of the prevailing trend, as well as potential support and resistance levels. Support is a price level where buyers tend to enter the market and push the price higher, while resistance is a price level where sellers tend to enter the market and push the price lower. To draw a trend line, you need to find at least 2 points that touch the price action. The more points that touch the trend line, the more valid and reliable it is. You can draw an upward trend line by connecting 2 or more higher lows, and a downward trend line by connecting 2 or more lower highs. You can also draw horizontal trend lines by connecting 2 or more equal highs or lows. Trend lines can help you identify trading opportunities in a volatile gold market by showing you when the price is likely to bounce or break out of the trend. For example, if the price is in an uptrend, you can look for buying opportunities when the price touches or approaches the upward trend line. Conversely, if the price is in a downtrend, you can look for selling opportunities when the price touches or approaches the downward trend line. However, trend lines are not always reliable and can be broken by strong price movements. Therefore, you need to use other technical analysis tools to confirm your trading signals and manage your risk. One of these tools is support and resistance levels. Support and resistance levels are horizontal price levels that act as barriers for the price movement. They are often based on previous highs and lows, psychological round numbers, or Fibonacci retracements. Fibonacci retracements are percentage levels derived from the Fibonacci sequence, a mathematical pattern that appears in nature and financial markets. The most common Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 76.4%. To use Fibonacci retracements, you need to identify a major swing high and a major swing low on the price chart. Then, you can use a Fibonacci tool to draw horizontal lines at these percentage levels between the swing high and low. These lines represent potential support and resistance levels where the price may reverse or stall. Fibonacci retracements can help you identify trading opportunities in a volatile gold market by showing you where the price may retrace to before resuming its original trend. For example, if the price is in an uptrend, you can look for buying opportunities when the price retraces to one of the Fibonacci levels and bounces back up. Conversely, if the price is in a downtrend, you can look for selling opportunities when the price retraces to one of the Fibonacci levels and drops back down. However, Fibonacci retracements are not always accurate and can be breached by strong price movements. Therefore, you need to use other technical analysis tools to confirm your trading signals and manage your risk. One of these tools is moving averages. Moving averages are indicators that smooth out the price action by calculating the average price over a certain period of time. Moving averages can show the direction and momentum of the trend, as well as potential support and resistance levels. There are different types of moving averages, such as simple moving average, SMA, exponential moving average, EMA, weighted moving average, WMA, etc. To use moving averages, you need to choose a time period that suits your trading style and strategy. The longer the time period, the smoother and slower the moving average will be. The shorter the time period, the more responsive and faster the moving average will be. Moving averages can help you identify trading opportunities in a volatile gold market by showing you when the trend changes or continues. For example, if you use two moving averages with different time periods, such as 50-day SMA and 200-day SMA, you can look for crossover signals. A crossover occurs when one moving average crosses above or below another moving average. A bullish crossover occurs when a shorter-term moving average crosses above a longer-term moving average, indicating that the uptrend is gaining strength. A bearish crossover occurs when a shorter-term moving average crosses below a longer-term moving average, indicating that the downtrend is gaining strength. You can also use moving averages as dynamic support and resistance levels. For example, if you use a 50-day SMA, you can look for buying opportunities when the price bounces off or stays above this moving average in an uptrend. Conversely, you can look for selling opportunities when the price drops below or stays below this moving average in a downtrend. However, moving averages are lagging indicators that reflect past prices rather than current prices. Therefore, they may not always catch up with fast-changing market conditions and may give false or late signals. Therefore, you need to use other technical analysis tools to confirm your trading signals and manage your risk. In conclusion, technical analysis tools such as trend lines, support and resistance levels, Fibonacci retracements, and moving averages can help you identify trading opportunities and entry and exit points in a volatile gold market. However, these tools are not perfect and may not work all the time. Therefore, you need to combine them with other factors such as market sentiment, fundamental analysis, risk management, etc., to improve your chances of success.